Welcome back to Calm Investors. I am Ruth.
And I am Patrick and Ruth. This is the last episode of Season 1.
It is, and I have to say, Patrick, you are not the same person who started this season.
You know what? I am not. When we started this season, I was the guy who almost panicked sold his 401k after a 2% drop. I had my finger on the button. I was ready to move everything to cash because the market had a bad Tuesday, and now I can name the bias that was driving that decision. I have a written plan for what to do in a crash. I understand why my brain reacts the way it does, and honestly, I feel like a different investor. But am I actually ready?
That is what we are going to find out today. Because today is not a lecture, today is a test. We are going to run through everything you have learned this season, the complete psychology checklist, and then I am going to put you in 3 real-world scenarios and see how you respond.
A test. All right, I am ready, I think.
Let us start with the checklist. 11 episodes, 11 tools. Here is what you now know. Episode 1. The Behavior Gap. The average investor earns roughly 1/3 of what the market returns. The gap is not about knowledge or stock picking. It is entirely behavioral, and you know how to close it.
The Dalbar study, 10% versus 3.5%. The gap is behavior, not brains.
Episode 2. Mr. Market. The stock market is an emotional business partner who offers you prices every day. He is there to serve you, not to guide you. His mood is not your problem.
Price is what Mr. Market quotes you. Value is what the business is actually worth. They are often very different.
Episode 3. Loss aversion. Losses feel roughly twice as painful as equivalent gains feel good. This drives you to hold losers too long and sell winners too early. You can override it with preset rules. Episode 4. FOMO and herd mentality. The urge to follow the crowd into a hot investment is a survival instinct misapplied to markets. Every bubble in history follows the same pattern. You can recognize it now.
Tulip Mania, 1637, equals meme stocks 2021. Same brain, same biases, 400 years apart.
Episode 5. Anchoring and confirmation bias. Your brain latches onto the first number it sees and seeks information that confirms what it already believes. You now seek disconfirming evidence instead. Episode 6. Recency bias and overconfidence. Your brain gives disproportionate weight to recent events and mistakes, short-term patterns for long-term trends. You use base rates now, not gut feelings. Episode 7. The emotional cycle of markets. Every market cycle follows a predictable arc from optimism to euphoria, to panic, to despair, and back again. You can locate yourself on the cycle and override emotion with logic.
Maximum risk is when it feels safest. Maximum opportunity is when it feels most dangerous.
Episode 8. Financial media. The news sells attention, not advice. Expert predictions are barely better than random chance. You have curated your information diet. Episode 9. The Psychology of Risk. Risk is not volatility. Real risk is the permanent loss of purchasing power. You understand the 3 types: tolerance, capacity, and need, and you know they often conflict. Episode 10. Patience. Compound growth is backloaded. The first decade feels slow. The last decade feels like magic. Patience is a skill, not a personality trait. And you have the systems to make it the default. And Episode 11. Your investment policy statement. A 1-page document created in calm that you follow in chaos. The 72-hour rule, quarterly check-ins, automation, and accountability partner. Your emotional armor is built.
11 episodes, 11 tools. I have to say, hearing them all listed like that, it is a lot, but it all connects. Every piece builds on the one before it.
It does, and now let us see if you can use them. Scenario test time, are you ready?
Let us do it.
Scenario 1. You wake up on a Monday morning. The market just dropped 35% in a week. Headlines are apocalyptic. Your coworkers are panicking. Your portfolio is down, more than you have ever seen. Your phone is blowing up with people asking what to do. What do you do?
Okay, first thing. I do not log into my brokerage account. That is my 72-hour rule from my IPS. I wait. I let the emotional intensity fade second. I pull out my investment policy statement and reread it. My crisis rules say exactly what to do in this situation. I wrote them when I was calm and thinking clearly. Third, I call my accountability partner not to ask what to do, but to have someone read my plan back to me and remind me that I prepared for this. And fourth, I remind myself that every major crash in history has been followed by a recovery. The emotional cycle says, I am somewhere near panic or capitulation right now. That is the opportunity zone, not the danger zone. I do not sell. I follow my plan, and if my automated contributions are still running, I am actually buying more shares at lower prices.
That is a perfect answer. Every single piece of that came from what you learned this season: the 72-hour rule, the IPS, the accountability partner, the emotional cycle, the historical data. 6 months ago, you would have sold everything.
6 months ago, I almost sold after a 2% drop, a 35% drop. I would have been gone.
Scenario 2. Your coworker comes to you on a Friday afternoon. He is buzzing with excitement. He just made 200% on a stock tip from someone online. He tells you the stock is still going up. Everyone in the office is buying it. He says you need to get in before it is too late. What do you do?
Okay, I recognize this immediately. This is herd mentality and FOMO. Episode 4. Everyone is buying. It feels like I am missing out, and the social pressure is intense. But I know the pattern. Smart money enters early. Media coverage follows, then retail FOMO, then euphoria, then crash. If everyone in my office is already buying, I am probably near the euphoria stage, not the early stage. The crowd is wrong at extremes. I also check my IPS. Does this stock tip fit my plan? No, my plan says index funds, automated contributions, long-term horizon. A hot stock tip is not part of my strategy. So I say, that is great for you, and I go back to my plan.
Excellent. You identified the bias, you recognized the bubble pattern, and you checked it against your IPS. That is exactly right. The hardest part of that scenario is not the analysis. It is watching your coworker make money and feeling like you are wrong. But you know that feeling is FOMO, not logic.
And I know that the coworker who made 200% is the one who gets talked about. The hundreds of people who lost money on the same stock tip, nobody talks about them.
That is survivorship bias, and the fact that you just named it without me prompting you tells me a lot. All right, scenario 3. You are watching television on a Sunday night. A well-known financial expert comes on. Nice suit, confident voice. He says with absolute certainty that the market is going to crash next month. He has charts, he has data, he sounds very convincing. What do you do?
I remember Philip Tetlock, Episode 8. Expert forecasters are barely better than random chance, and the most confident ones, the ones who get on television, are actually the least accurate. Confidence is not accuracy. This expert sounds convincing, but so does every expert who has ever been wrong, and they are wrong most of the time. I also remember the headline contradiction game. If I looked hard enough, I could probably find another expert on a different channel saying the exact opposite thing with equal confidence. The information content of any single prediction is essentially zero. So what do? Nothing. I do not change my plan based on one person's prediction. I check my IPS. My plan was not built on predictions. It was built on principles: long-term investing, diversification, patience. Those do not change because someone on television had an opinion.
Patrick.
Yay?
6 months ago, you would have sold everything after a 2% drop. Today you are quoting Tetlock back to me, identifying survivorship bias unprompted, and checking every impulse against your written plan. That is the transformation. That is what this season was for.
I have to be honest, Ruth, it does not feel like I learned a bunch of facts. It feels like I see the world differently now, when I look at a market headline. I do not feel the same panic I used to. I still feel something, but now I can name it, and when you can name it, you can manage it.
When you can name it, you can manage it. That is beautifully said, and that is the entire point of behavioral finance. Not to eliminate emotions, you cannot do that, and you should not try but to recognize them, name them, and have systems in place so they do not drive your decisions.
So where does this leave us? We have been on quite a journey. Season 0 built the financial foundation, debt plans, emergency funds, savings habits, goals. And now, Season 1 built the psychological foundation, biases, emotions, systems, armor. What comes next?
What comes next is the question you have been waiting to answer since we started. You are financially prepared. You have the emergency fund, the goals, the account knowledge. You are psychologically prepared. You understand your brain. You have your IPS. You have your armor. The next step is learning what to actually invest in. Stocks, bonds, index funds, asset allocation, building your first portfolio. That is where the journey continues.
And I am actually excited about that. Not scared excited, which is a sentence I never thought I would say about investing.
And that is the best sign that you are ready, because the best investors are not the smartest. They are not the ones with the most information or the best predictions. They are the most emotionally disciplined, and that discipline does not come from willpower. It comes from preparation, from understanding your brain, from having a written plan, from building systems that make good decisions. The default, you have done all of that.
Discipline comes from preparation, not willpower. That might be the single best sentence from this entire season.
All right, let us lock in the final takeaways for Season 1. Number 1. You now have a complete psychological toolkit. You understand the behavior gap, the major biases, the emotional cycle, media manipulation, real risk, and the power of patience. 11 tools, 11 episodes, 1 armor. Number 2. Knowledge alone is not enough. Your investment policy statement and crisis rules are what will protect you when emotions run high. The plan you made in calm is the plan you follow in chaos. Number 3. The best investors are not the smartest. They are the most emotionally disciplined, and that discipline comes from preparation, not willpower. And number 4. You are ready. You have the financial foundation, you have the psychological foundation, and you have the tools, the systems, and the armor to invest calmly for decades.
And your homework for this finale? Review your investment policy statement from last episode, then run through the 3 scenarios yourself. Market drops 35%. What do you do? Everyone is buying a hot stock. What do you do? An expert predicts a crash. What do you do? If your answers align with your IPS, you are psychologically ready to invest. If not, go back and revisit the episode that covers that bias. The episodes are not going anywhere. Neither is your journey.
If this season changed how you think about investing, follow Calm Investors wherever you are listening. Share this with someone who is about to start their investing journey. The best gift you can give them is not a stock tip. It is the psychological armor to survive the first crash.
Thank you, Ruth. Genuinely, this season changed how I see everything, and thank you to everyone who has been listening. This has been an incredible ride.
Thank you, Patrick. You showed up, you did the work, and you are ready.
Stay calm, everyone.
Build wealth.